I know it's hard to believe, but one of these days the market is actually going to bounce. Every day the market sells off, we're that much closer to the day it will bounce. It's just a matter of time. I'm Seth Freiberg, the head trader of SMB Capital's options trading desk here in Manhattan. The traders on our proprietary trading desk are trained to think ahead and prepare for whatever the market will be offering us up next. In today's video, we're going to teach you a very simple yet powerful technique for taking advantage of a market bounce in a low risk, high reward way. So if that sounds like something you'd like to learn, then stick around. This could come in handy one of these days. Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so unless you're hiding under a rock somewhere, you're aware, probably painfully aware, of the fact that we are officially in a bear market as of this week, with the SPX index closing well into bear market territory during the meltdown that took place on Monday. And so what often happens in situations like this is that traders can tend to get caught up in continuation bias, where you believe that what just happened is likely to continue happening no matter what. And of course, while trends absolutely do take place and can be very profitable to follow, there is always an end to every sell-off, just as there is always an end to every rally. And so this is a very good time to begin implementing trades that anticipate that bounce and take full advantage of it. And options provide you with a unique opportunity to make low-risk, high-reward trades when the inevitable market bounce does arrive, and the wise trader is always thinking ahead and planning how to best leverage these inevitable market changes. Now, before we get into how we can construct an options trade to take advantage of the eventual bounce in the market, I wanted to let you know that if you would like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. Okay, so in order to explain how this strategy works, we need to make sure that everyone watching this video understands how index options work. So we're going to do a really quick review of them, and then we'll jump right back into the details of the strategy. All right, so the best way to understand index options is to think of them as bets. What are known as a call option pays off if an index closes above what's known as the strike price of the option on the day that the option expires. If the index does close above that price on expiration, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option, again, $100 per point, that the market closes below the strike price of the put. So for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which was 4,000. However, the 40.75 call, that one would expire worthless, as the index didn't close above 40.75, so the call seller just pockets the premium he collected. And the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put's strike price of 40.75. But the 4,000 puts would expire worthless because the market didn't close below the 4,000 strike price. All right, with that said, let's take a historical example of what I'm talking about, which you'll easily be able to translate into today's market environment. So let's head back to the fourth quarter of 2018, which was an environment not too different from today, when since October 1st of that year, the very beginning of the fourth quarter of 2018, the SPX index had started to sell off, reaching a loss of more than 13% of its value by December 7th. So it was a similar pattern to what we're seeing today. So let's suppose that you wanted to set up a trade that would take advantage of a market bounce on that date. And so suppose that on December 7th, we went out about 2 months to February 15th options chain and bought 5 calls at the 26.50 strike price above where the market was trading that day. And that part is understandable, right? You're buying calls, betting that the market will rally before February, but then you do something that most people would consider counterintuitive. And you go ahead and sell 5 calls expiring a month earlier in January. So when you've done that, you've actually created what options traders refer to as a call side calendar spread, where you sell an option at one strike and then move to a later options chain and buy an option at that same strike. Now, let's first off look at the cash flow of what's happened so you'll understand the significance of this. And as you can see, buying 5 of those 26.50 calls expiring in February costs $88.55 a piece, and each one of those pays off at $100 per point above 26.50. So you multiply that by 100, and you bought 5 of them. And so multiplying it all out, you end up spending $44,275. But then you turn around and sell the 26.50 calls expiring in January for $68.75, resulting in cash inflow of $35,375, ultimately resulting in a net cost of only $9,900. Okay, so now let's move to the end of that year. And as you can see, the SPX index kept selling off further, with the index only beginning to bounce right after Christmas. So now if we move forward to January 17th, which is the final trading day for the January calls we sold, you can see that the bounce has continued into the new year. And in fact, by the close on January 17th, the SPX index had rallied to 2635. And so suppose at the end of that day that we decide to buy back those January call options to close the short call position out, and we'd have paid $2.28 a piece for those. And so that position's been closed out. Now we'll come back to that a little bit later, but just keep in mind that we closed the short calls, and the only thing left now in the trade is those long calls we bought in conjunction with entering into this call calendar spread. All right, so let's now move to the final day that those 5 long February calls are trading. And as you can see, the index had rallied further to 2745. And so because this is the final trading day of those options, we can sell those for $96.35. As you can see, because their strike price is almost 100 points below the index price that day. And so those calls have a lot of value because they are worth $100 per point for every point the index is above 2650 when they'll be valued, which is the very first thing the next morning. And so if we go ahead and sell those, we will have closed the position. So let's take stock of what's happened here, because there have been a lot of moving parts so far. Okay, so first of all, let's see what we received from selling those 5 February calls. And as you can see from the calculation, having received $96.35 for those, we receive a total of over $48,000 for the calls. But remember, we had a cost, not a big one, but a cost to close the January calls, which as you can see was just $1,140. And of course, we had the original cost of the calendar spread in the first place, which was $9,900, resulting in a profit of $37,135. That's a 375% return on the original the cost of the trade, which is not too shabby. So how did we make such an incredible return? And the answer lies in the fact that the short calls we originally sold, the January calls, were so valuable when we sold them that they reduced the overall cost of the calendar spread to $9,900, resulting in that 375% return. But had we just bought the calls, which would have set us back $44,275, we would have received that same $48,175 for selling them, but this time we need to compare that to a much larger original cost of over $44,000, resulting in a return of only 8.8%. And so what I'd like you to take away from today's video is that if you have a conviction that the market's going to bounce eventually, then buying a calendar spread above the market has the potential of immensely increasing your returns on a trade. And that's because outright buying the calls is much more expensive than buying the calendar spread, where the calls that you're selling offset, in some cases massively, the cost of the calls, resulting in a much cheaper trade to enter. If, as in this case, the short calls are able to be bought back cheaply as they're about to expire, you can have a huge win if the market keeps rallying, as we saw in this case. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll be learning 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.